In this presentation, we're going to close out the balance that's in factory overhead at the end of the period within QuickBooks Pro, QuickBooks Desktop. Here we are in our practice problem, one job cost tracking work in process. We currently have the open windows open. You can open the open windows by going to the view dropdown and the open windows list. We're going to open up our report by going to the reports dropdown. We're going to go down to the accounting and taxes. We're going to select the trial balance. Within the trial balance, we're going to change the dates up top from 01/01/20 to 12/31/20. That's January through December. The account we're concerned with is the factory overhead here. Now, to see this, let's think about this on our Excel worksheet first. If we go to our Excel worksheet, so I'm going all the way to the example tab. You'll note everything that's in factory overhead within the example tab I can find by basically using this item. And that's going to be in, if you go to the formulas, and they're in the formula auditing section. So everything that went into factory overhead, all these things that we couldn't apply to the job, these were items that increased the factory overhead. So we put them into the factory overhead. Those were the actual costs. We applied the amounts for factory overhead to the job, and we did that with an estimate, which was this one. So because it's an estimate, obviously it doesn't come out perfect. So what we end up with is a balance at the end of the time period, in this case being 3,000. If I go back to our end report, the one we're currently on, then you'll see because of that estimate, we're left here with 3,000 here. Now, our goal here, the goal is to say, well, hopefully this amount is immaterial. We had an estimate. Of course, the estimate isn't exact. If it's small in comparison to the other numbers, it's not material, then we want to just write it off so that we can start over the next time period. The easiest account to write it off to is an income statement account, because it will then close out to the equity section at the end of the time period and therefore disappear at that point. So what we want to do then is take this amount and say, hey, that's just an estimate. It's a small amount. It's off. And like of course it would be as an estimate. We're going to write it off. We're going to make this account zero, in other words, and start over in the next time period, writing it off to a cost of goods sold account. So all we're going to do is go down here and say, well, there's 3,000 in it. It happens to be a credit. We need to go down. So we're going to do the opposite thing to it, which is a debit. So we're going to debit that account for the 3,000. And we're going to credit the other account that will be involved. That's going to be cost of goods sold. Now, this should look funny. You're going to say, well, why would we credit cost of goods sold? Notice we don't normally credit cost of goods sold. It's just because it's an estimate. The estimate was off. This is the easiest way to just clear out the estimate. At the end of the day, everything would close out to cost of goods sold. So therefore, we're just going to put it there, and that's going to be the easiest thing to do. And then it will close out into equity, and we can start over with a fresh zero account in factory overhead as we can then start a new estimate. So to post this then, we're going to say that the factory overhead is going to be debited, bringing it down to zero. And then the cost of goods sold account is going to be the credit. Notice nothing is happening to the work in process or the finished goods, and therefore nothing has to happen to the job reports. So this is a fairly straightforward journal entry. So all we're going to do, I'm going to go back over here to QuickBooks. I'm going to do a journal entry for it, straightforward transaction journal entry. This is a period end adjustment that will typically be made. We're going to go to the company file. I'm going to go to the make journal entries. We're going to make this as of the end of the period. And we're going to say that this is going to be the debit we determined was going to go to the factory overhead. So factory overhead for 3,000. Close out. I'm going to say close out factory overhead. And then the other side is going to go to cost of goods sold. And I'll just say this same memo in it. So we'll just take this same memo, put that down below. There we have it. So same transaction. I'm just going to say save and close and say yes. And then same thing will happen here. Factory overhead on the trial balance. We're in the trial balance. It is back down to zero. So factory overhead is zero. Double clicking on it. Then the factory overhead is down to zero. Here's our transaction. Closing this back out. The other side of it then being in cost of goods sold. Double clicking on it. Looking at the cost of goods sold. There's our transaction. If we just consider the financial statements at the close here, if we go to the reports up top, company and financial profit and loss report. We're going to say we have 0101 20 to 12/31/20. There we have it, and all we have is our income and our cost of goods sold, and the difference is going to be that 58.8, as we see in our worksheet here, 58.8, that's income, not a loss. And then on the balance sheet side of things, if we go to the reports up top, company and financial, and scroll down to the balance sheet, and change the date to, let's just say 12/31/20, there we have it, and we have our cash, we have our accounts receivable, we have our raw materials, and then our work in process account. That's the one that's going to be supported by the job reports. And then we've got the accumulated depreciation and the factory overhead, and then the accounts receivable down, accounts payable down below, and then the equity section, and then of course the income, the net income, being reflected the same amount on the bottom line of the profit and loss report.